And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcoming you here for another macro monthly update on a Wednesday with the macro maven herself, Stephanie Pomboy. Hi, Steph. How are you?
I'm great. How are you?
I am good. Good to see you. I hope the past month has been good to you. I hope you had a good Thanksgiving. I hope you're looking forward to the Christmas holidays.
Yeah, thank you. Merry Christmas. I am looking forward to it. It's 80 degrees here, though, so it's hard to feel really Christmassy, but Wilhelmina has her Christmas nutcracker out. I had to set that aside so she didn't decide now is the time to play.
That's great. It's much more winter-like conditions here in Reno. And actually, I'll just apologize in advance if folks can hear the wind howling outside the window here. We moved here about 2 months ago or so, and there have been a couple bouts of like 100-mile-an-hour plus wind gusts, and we missed the past couple ones. We were away for the weekend or whatever when they were happening. Well, we finally found out last night what everybody was talking about. Crazy. I've been up since like 3:30 with dogs that were in the bed who weren't understanding what was going on out there, and it still is kind of ripping. So let me know if it gets in the way of the volume here.
Crazy. That's some severe weather. You probably, I'm sure Ashley feels like Dorothy and Toto with your dogs there.
A little bit. Although I think, unlike Dorothy, I think she was considering throwing them out into the tornado last night. But I did wake up. I'll see if I can load it while we're talking here. I did wake up to just a gorgeous rainbow, like a full rainbow going across the horizon. So if I can pull it up here so folks can enjoy, I will.
Yeah.
But we've got a lot to talk about here, Steph. And why don't we start with the most important topic, which is your conference, the super terrific Happy Day, is coming up faster than I think, be here before everybody knows it. Can you just give interested folks direction on where they should go to sign up for that if they're interested?
Yeah, absolutely. Well, I can post a link on my Twitter. Actually, I have posted it a few times on my Twitter feed, but I'll do that again after we log off here.
Okay. But if sorry, I'm just putting your Twitter handle right up there on the screen at @Pomboy, so folks know where to go.
Thank you. Alternatively, if people are trying to find it, they can just go to my website and just hit the info at Macro Maven's contact, and we'll send you the link. I need to get it posted on the website. I haven't done that yet, but if you just email us, we'll get you that link. But the exciting thing is that you have decided to grace us with your presence. I'm super happy about that. It's going to make it even more of a spectacular conference. We did this for the first time last year and had such great feedback from people. I mean, it was not like any conference I've ever been to, because there was such a sense of camaraderie between the speakers and the audience. It was kind of like a big family in a way, having a conversation about, the big investment themes of the year. And people were just really excited to come back and do that again. And you're just such a natural fit with that audience. So I'm very excited, and we've got some great speakers lined up and whatnot. But you can learn all about that by looking at the link on my Twitter feed or emailing, and I'll send out the agenda. But it's going to be great. And it's right after the President's Day weekend in mid-February here in South Florida, sunny South Florida, St. Pete. It's going to be great. So plan accordingly.
All right. Well, look, it was a huge honor to be asked. It's a real privilege to go there. So folks are thinking about going and decide to go, I look forward to meeting you all there. And that's really one of the things that I don't do too many live events during the years, just because this gig keeps me so busy. Yeah. But I really appreciate it when I do, and you get to actually interact, face to face in real time. It's really helpful for me to talk to people that watch this channel, and I get some of my best ideas from those conversations. But as an attendee of these things as well, it's really great when you get the opportunity to not just sit in the audience and hear somebody on the stage, but to actually get to interact with them, off the stage. You're really in your conference, from what I understand, is kind of that on steroids, where you're all kind of mingling together. It's not necessarily faculty and audience, right?
Yeah, absolutely. I mean, we try to make it as interactive as possible. And so, it's like I said, it's not your typical conference. People don't get up and have slide presentations. I mean, maybe a couple of people will do that, but the norm is a fireside chat between, Grant and someone, or myself and someone, and then we'll take questions from the audience and really try to make it as interactive as possible. And then we do a live super terrific happy hour where all the speakers are on the stage, and we just sit there and take questions from the audience and all of that. So it's really a great experience, and you'll see a lot of people familiar. Like we've got Tom Hennig, the Kansas City Fed guy, coming. Tom McClellan of the McClellan Oscillator, also been interviewed by you. Mike Green, who everyone should be familiar with all his work on, the impact that passive investing is having in terms of concentration in the markets and the implications of that. The list goes on. I don't want to reveal all of the exciting speakers, but that's a tease right there. And of course, you're going to be there to help us MC this whole show and really engage the audience with the speakers. It's going to be tremendous. I'm really excited, and I think you will add an extra element of real insight and power to this.
Well, you're being too kind. Not only will it be tremendous, I'm sure it's going to be super terrific. And, those three gentlemen you just mentioned, they're all guys who I really have enjoyed interviewing, getting to know over the years, and I have not met them in person, so I'm very excited for
that. It'll be fun.
All right, folks, I promise we'll get to the meat of this macro discussion in just a second. Two quick things. One, I did manage to upload it, so just to show you guys, this is what I woke up to this morning. This beautiful full rainbow. But we're also going to end a little bit early today. We're going to go for the next 50 minutes, but I've got to end about a minute or two before the hour because great independent journalist Matt Taibbi is coming on, and I've got to scoot over to record that one, and that interview is going to go out tomorrow. So hopefully that's exciting to folks. All right,
that's going to be fantastic.
It really should be just great. I saw Matt in person a few months ago, and we talked about recording something special for Thoughtful Money. So that's like I said, I'm like a kid waiting for Christmas here. Okay, Steph, so much to talk about. I'm going to throw some things up here. We'll talk about those. We'll talk about anything else that's burning brightly on your radar, and then I'll try to take as many questions from the live audience as well as we go through here. There's a chart you put up, which I'll put up in just a minute if I can. But you had put out on X recently that you think people are kind of missing a big development in the AI space, which is how there's just an unbelievable amount of funding that this space needs. I think at the last I saw was like $1.5 trillion. And there is an increasing competition to borrow that money from both the private and the public markets. And there's actually kind of several important questions that competition raises. But I think your point was a fair one, which is I don't hear a lot of discussion about that competition. So tell me, why is that burning brightly on your radar right now?
Yeah, it's amazing. So we knew, and I've talked about with you at length, about all the corporate debt that needs to roll over the next several years. And we're looking at, over $1 trillion in these are corporate bonds that need to be rolled over each year for the next 3 years. I think, in fact, it adds up to almost $4 trillion over the next 3 years in corporate debt that needs to be refinanced. And that's, existing debt. That's not new borrowing to fund AI CapEx, which is what we're seeing now just take off. And it's being done by a lot of companies that have cash on their balance sheet that are, Google, Meta, these kind of big companies that are undertaking these huge investments in AI. And so estimates I've seen, I think so far this year, the latest numbers are that there's been like $150 billion worth of borrowing, but they estimate that going to $1 trillion by 2028, which is just, a couple of years out. So this area is really going to place increasing demand on capital markets. We'll see at the margin, more money flowing to AI CapEx, and presumably at the expense of other borrowing. So we've got, obviously, the public sector has an enormous amount of debt that has to roll over the next year. I mean, we've got $7 trillion in T-bills outstanding. So you know that each year, pretty much, we've got to roll at least $7 trillion unless we start to shift the composition of issuance. And right now, Treasury Secretary Bessent shows zero inclination to do that. Mm-hmm. So we're looking at $7 trillion minimum from the public sector in terms of demand for capital. Then you've got this, extra trillion in existing corporate debt that needs to roll. And then you're layering on another, could be $1 trillion in terms of funding AI CapEx. And then you've got state and local borrowers, and obviously you have consumers who need to borrow. We've got margin debt that's hitting all-time record highs. The demands for capital are just intensifying. And so I think there's a question as to, who's going to get left out by the wayside.
Right.
And I'm thinking, it remains to be seen, obviously, and a lot will depend on what the fundamentals look like in terms of the healthy economy moving forward. But when you think about my pet topic, which has been the misperception about the strength of corporate balance sheets and the idea that, there's plenty of cash on hand because people look at the total and they don't look at the fact that all the cash is held by the top 10 companies and everyone else is basically nothing. And, the bottom 50% can't rub two nickels together. So the question is, if you've got a very top heavy sort of corporate sector, and yet you've got, junk spreads that are pushed to the mat. If you're an investor and you're given an opportunity to extend more credit to some junk rated borrower or to lend money to Google, it seems to me like for the amount of extra yield you're getting for taking that massive risk by going down the credit curve, you might decide, hey, maybe I want to actually shift and take advantage of this opportunity because these companies weren't really big borrowers, Mm-hmm. So now there's potential crowding out there of sort of marginal credits. Or you could see perhaps a barbell where people continue to lend at higher rates to the real junk companies, and then they're lending to these higher quality borrowers. And that BBB segment of the investment grade universe, which is more than half of the investment grade universe now, gets completely left by the wayside, in which case, that would be really an existential threat for those companies again, because they all have this massive amount of debt that needs to roll over the next several years. So it's just, I'm just throwing that out there as a topic to think about because there's a lot of acknowledgement about this capital demands from AI, but not as yet any connecting the dots to what the implications are for everybody else who needs to borrow as well. To say nothing of the federal government and, the competition for capital there, because presumably if you can lend to the government at 4 and you can lend to, Google or Meta or these other companies and pick up a little more yield, that might actually be more compelling to some investors.
All right, so let's pull at a few of those threads here. Increasing competition for debt buyers out there, right? AI complexes raising all this debt. The government has to raise the $7 trillion that you talked about, or roll over the $7 trillion, and we've got the debt maturity wall, which you and I have been talking about forever, right?
Yes.
So you can argue that the AI debt is productive debt, that we're going to get some sort of future return on that spending, right? I mean,
you could. There's a huge debate about that, but yes.
It's debatable, but you can make the argument, right? You can't make that argument with the debt maturity wall or with the Treasury rollovers, right?
Yeah.
That's debt that was taken on in the past. Whatever economic benefit we were going to get from it, we got from it. Now this is just living with the legacy of this, right? So, a fair amount of this competition is going to be taking money that's going to go to things that don't have a return on them.
Right.
So you raise a really good question here, which is like, all right, to the extent that there just aren't infinite debt buyers out there, what is this race crowding out? Like, what other things that we could be investing in as a society are not getting fed here? The smaller but more innovative companies on the public side, rebuilding key infrastructure, things that we could get long-term benefits from. Like, what's the probability you think we'll look back at this scramble right now and say, we shoved a lot of capital into stuff that just really didn't do anything for us?
Yeah, well, I mean, I think even around AI, there are a lot of people who liken this, I think, correctly to the dot-com bubble, which is to say that the internet was a thing. Dot-com was a thing. It didn't go away. There were just a lot of companies that came into existence then that don't exist today. So you started with an idea that was valid, and then you had a tremendous amount of money, let's say, that went into irresponsible malinvesting, and that ultimately got flushed out. And I think, you can draw the parallel to AI today, where yes, obviously artificial intelligence is going to be with us. It's, something that will be durable into the future, but that's not to say that there won't be a tremendous amount of, let's say, creative destruction as we flesh out the wheat from the chaff, as it were, in that space. But, in the interim, it's this question about the push and pull between, I believe, this happening against the backdrop of a public sector trying to finance the largest deficits in our lifetime, and doing so with T-bills that require constant rolling over. So, if we got 7 trillion that we've got to do, that creates a different backdrop from what we've seen in prior episodes, where you have these kind of malinvestment bubbles, these credit bubbles, where at least you didn't have massive competition for capital coming from the public sector at the same time.
Right.
So this is unique. And if you have, again, it comes back to what is your outlook for the economy? Because if you think that we're actually going to head into a slowdown, God forbid, a recession, that public sector borrowing requirement is only going to increase further. So, the deficits will expand from a, counter-cyclical standpoint. So that's just going to be another moving part in this drama. So I'm just speculating, my comment about the triple B swath of investment grade is, something I think is a potential implication, but one which, time will tell, and it will depend greatly on the outlook for the economy and where we're headed, and, whether the one big beautiful bill does in fact create this kind of liftoff in the first part of next year or not. So a lot of things that are kind of up in the air, and we'll bear watching.
Okay. All right. I want to pull on this thread a little bit more. Steph, if you are not back-ended, I now have a little bit of flexibility. I just got an email from Matt's assistant saying that he missed his train, and that we're going to have to reschedule to early next week. So I don't have this back-ended constraint anymore. And hopefully that'll let us get to a little bit more live Q&A from the audience too. All right. So another thing about all this debt that's flooding into the system out there now, that presumably needs a buyer, is this concept of debt saturation, right? Where it's just like, we just might not be able to absorb all this, right? And you might have parties that just can't, right? They've bought so much debt, they've kind of hit their limit. It's like, all right, we just don't have any more room on the balance sheet to take on any more debt. Or you may get companies that have enough and say, maybe I could take on some more, but I just don't want to. And we're seeing that a little bit, even just today. The hits keep coming for Oracle, but one of the headlines today was that Blue Owl, which was in discussions with Oracle to fund I don't know, 10 billion or something worth of Oracle products for their build out, said, hey, you know what, we've changed our mind. We don't want your debt, right? So what I'm curious is with all of this supply and maybe some limits on demand, might we expect to see bond yields stay high or creep higher? Because people are like, look, if you want me to take this thing, you're going to have to really give me a sweet deal.
Yeah, absolutely. And I think that clearly is the relief valve for all of this, the basic law of supply and demand, and we're pumping in a tremendous amount of supply. So the price should go down, and conversely, yields should go up. And I think that's especially true for the public sector, and we're seeing that play out already. There was a interesting chart. This is kind of on a tangent. The BIS just did a paper, I guess they must have published last week, looking at the Treasury basis trade and its silent but expanding role in Treasury market dynamics. And basically, what they are underscoring is a point that I've made for ages now, and that is that in the absence of foreign central bank buying, sort of hedge funds have silently taken the place in terms of pulling a lot of the doing a lot of the heavy lifting on our deficit financing through this basis trade. They had a chart that puts hedge fund positions in the Treasury market over 4 trillion right now, of which I think they had 2.5 trillion was tied up in these basis trade or other relative value trades. So my point is that we are increasingly reliant on sort of fickle financiers, as it were, instead of these longtime central bank buyers who were relatively perfunctory. They would receive dollars in over the transom and recycle them right back into U.S. Treasuries. And so they were sort of durable and reliable source of financing. And now we're increasingly reliant on hedge funds positioning these highly levered basis trades, which, everyone in the audience is aware that I'm a pretty dyed-in-the-wool skeptic, but that doesn't exactly inspire confidence to me. So,
I'm sure nothing could go wrong there. Hedge funds, leverage.
I'm sure they'll hold those positions to maturity and everything will be totally fine. But in the in the small chance that they actually do unload, it could create some real havoc. But I think this is a great, you're the host, but one thing that is burning brightly on my radar is this whole topic as relates to what the Fed did since we last spoke with resumption of QE under a different name. Basically, they didn't call it QE.
Stephanie, it's not QE. They're just making sure there are ample reserves in the system.
Right, exactly. So, but essentially, you and I have had this conversation forever where I said, it's just a matter of time before they end up restarting QE, and they've done that, albeit under some euphemistic guise. But that's clearly where this has to go in terms of financing the debt.
How much do you interpret what the Fed is doing here as preliminaries to panic, as a prequel to panic? And I don't want to be histrionic here, but is this just, hey, there's a little bit of pressure in the plumbing and we're trying to, provide a little release? Or do you think this is more serious than Powell is letting on?
Well, I think the fact that Powell is doing it is a pretty strong statement about how urgent it has become.
Again, right? Because I guess he could just, if it weren't urgent, he could just leave it to his successor at this point. You deal with it, right?
Exactly. And he hasn't been trying to ingratiate himself with the administration. He just wanted to sort of present himself as someone who's standing pretty much in opposition, or if not in opposition, but as fiercely independent, let's put it that way. And so not kowtowing to the wills of the administration. But ultimately, the president may be pushing hard for a rate cut. This expansion of the balance sheet is infinitely more effective for him than a rate cut. So far we've seen 5 rate cuts, actually now 6, where the long end of the yield curve has not come lower. So you're moving the Fed funds rate lower and nothing else is following. So they've done that now 6 times. So clearly that lever is broken and the balance sheet is the tool that remains. And so I think that from the administration standpoint, this shift by the Fed is one that they should be very excited about, rather than continuing to push for rate cuts. But I digress. But I think that Powell, he did try to say, we knew this day would come when we'd get to the point of ample reserves and we'd have to, start to manage the reserves higher, I guess. But he confessed that arrived a couple of months sooner than they had anticipated. That was pretty much all that he did in terms of acknowledging that. But again, I'm a real let's say anti-Fedite. So I will go far enough to say that I think that the Fed has enough hubris to imagine that this is just a mechanical tweak and that they can manage this reserve situation, and that it is not, in fact, the initial steps of a broader implementation of some form of yield curve control. I think they have enough hubris to imagine that it's just this little discrete tweak and they've got everything in hand and it's going to be perfect. All evidence to the contrary.
Well, it'll be really interesting, especially if we have more developments on this, to get Dr. Honig's thoughts on this at your conference, straight from the source. Okay, so Stephanie, I have to come up with the titles for these live streams before you and I have talked. So I'm trying to intimate, topics that we're going to get into. So the one I picked for this, I don't know if you saw it, but
the unemployment rate.
Yeah, is the unemployment rate to spike in 2026, and Powell kind of surprised me. I think he surprised a number of people where he said, hey, look, we haven't had all the data sources that we usually have because of the government shutdown, but we've kind of come to the conclusion that that the BLS payroll data is exaggerated to the tune of about 60,000 jobs a month, which if you back that out, then job growth would have been negative for a number of the recent months, right? And it's sort of an admission by the Fed that, hey, the jobs market's maybe even weaker, than we've been thinking. And Powell has always taken care to say that the labor market is cooling. He's not saying, hey, everybody, it's falling off a cliff. Now, the Fed chair is probably never going to say that, But my question for you is in addition to saying that, we got data recently. I'm going to have to pull it up here. I think when you were talking, Steph, but we got data here recently that the unemployment rate increased up to 4.6%. Shoot, I thought I had this thing easy to pull up here, but I don't. But you guys have seen me pull this chart up before in the past, where I've got. Here's an older version of it. It doesn't have the latest 4.6%, but it's so small you can hardly tell anyways. But you can see in this data series here, which goes back to 1950, just about every recession was preceded by the Fed first hiking interest rates, then plateauing them, and then starting to cut, and then eventually kind of panic cut as the new recession hit. And concurrently, you would see the unemployment rate, which had drifted down from the last recession, clearly bottomed. And then, as soon as it starts to pick up, it kind of shoots up into the next recession, which is the gray shaded areas on this chart. So, I've asked you this question in the past, but it's like, okay, so what's the argument for why it should be different this time? And, with the Fed admitting that, hey, we actually think that even cooling numbers we've seen are probably worse than we thought. Sorry, that's the question I want to ask you, but let me give you one little extra bit of data point. So I think if Scott Bessent were watching this live stream and he was in here with us, he would say, oh, well, I'll tell you what's different this time is, we've been pushing all these economy-friendly policies over the past, 10 months. And those things are really going to start firing in earnest as we get into 2026. And, economy is going to have all sorts of tailwinds against it. And, it's going to be great. And, Goldman Sachs, even just this morning, put out a recommendation of like, hey, you should be going out there and buying consumer staples and consumer discretionary products. Go buy the alcohol companies, go buy the cigarette companies, go buy luxury, because the consumer is going to be back, baby, in 2026. So, in one sense, we've got this data that suggests the labor market's worsening, and I think you and I, we could rehash all the arguments we've made, which is why we think things could get even worse next year. On the other half, you've got, the administration and Goldman saying, hey, you know what, like it's going to start getting better. Help bridge those two opinions, and maybe you're just going to say they're full of it. I don't know, but has anything changed, I guess, in your outlook around this?
Well, I mean, I think one thing that Bessent would say too is that all of the investment agreements, the commitments that the administration has cobbled together from, international companies would boost domestic employment. So they're waiting for that to kick in as well. That would just be another thing to add to that argument that they would make.
Yeah. Sorry. One other thing that they make too is that we've seen the impact of the tariffs. Like it was a one-off price shock. So tariffs aren't going to be an issue in 2026.
Yeah. No, absolutely. And I guess that kind of dovetails into a point I was going to make. And that is that, you have to think about what we've seen in the way of employment growth in the context of profit growth. Because profits is the number one input into employment. You don't hire more people if your business sucks or is getting worse, right? You're quite the contrary. You're doing the opposite. So generally, the nerdy economist chartist in me would overlay employment growth with profit growth and have a hard time distinguishing one line from the other because they just move together. So to hear Wall Street tell it, profit growth is phenomenal, and yet employment growth sucks. So something isn't giving you the right reading. And when you look at consumer sentiment surveys and personal income and whatever, it wouldn't appear to be the profit numbers that are giving you the wrong. I mean, the employment numbers are giving you the wrong. If anything, the employment numbers probably overstated.
Yeah, and I'm sorry to interject, but is the reason the profit numbers may be giving us the wrong signal is that the profits are all in the hyperscalers.
Yeah, exactly.
Right. So, yes, the S&P has high profits, but they're in 10 companies, and the remaining 490, which is where the vast majority of the jobs are sucking wind.
Precisely. Yeah, that's exactly where I was going to go with that. That now you're talking about, again, this haves and have-nots in the corporate sector, and people look at the averages and draw grand sweeping inferences about the health of the corporate sector, when in reality, we're really talking about 7 or 12 companies, and everybody else is in a totally different situation. And you need only look at corporate bankruptcy filings. And I know I'm a broken record on this, but every time we talk, we have a new update, and it's worse than the last one.
Okay, and I was going there. Okay, yeah. So the beatings continue.
Yeah, I mean, now we're on track. This year will be the largest year for corporate bankruptcy filing since 2011, which obviously was the back end of the financial crisis. Yep. So in terms of, when you look at a chart of bankruptcy filings and you go along and then you get 2008 and you come down to 2011, then you go along and then you come up to now. The only reason it's the highest since 2011 is that it was coming down to this point in 2011. But when you're trying to look at periods where bankruptcies are accelerating at the pace they are right now, the last time we saw that was going into the global financial crisis, so, in 2007-8. So this is obviously not a backdrop that is reflected anywhere in the market averages where the presumption is that every company is doing phenomenally well, when in reality, this is why you're seeing this massive corporate bankruptcy cycle and employment that is far weaker than you would naturally expect it to be relative to the printed numbers on S&P earnings.
Okay. So I want to ask you about retail sales in just a second, because obviously as retail sales go, we're still a 2/3 driven consumer economy. If retail spending gets compromised, that obviously, would be highly correlated with, or highly likely to generate additional layoffs. I just want to note, I don't know if she would say the same thing, but as you were talking, I was just remembering a conversation that I had with Anna Wong, who's the chief economist at Bloomberg Economics. And this was probably in the first half of 2025. And the employment rate was starting to creep up. And she had one of the highest, maybe it was even earlier than that, but she had one of the highest unemployment projections on the street, which eventually proved to be correct. But I remember asking her, I was like, all right, at what, we're not in a recession and these levels aren't recessionary yet, but like when's it going to start to bite? Like when are people really going to start to feel like rising unemployment's a problem? And I remember she said, once we cross like 4.5%, she said, I think that's when people are really going to start to really feel it. Well, now we're at 4.6%, right? And I've done enough of these interviews to know that in a K-shaped economy, the top half can be feeling just great, and the bottom half can literally be in their own personal recession. And I think probably a lot of people watching here, based on their previous comments on videos I've done here, a lot of them either know people that are really hurting or themselves feel like they're in a personal recession right now. So anyways, in terms of going into next year, what is retail sales looking like? Is it still pretty much, on average, being propped up by the top 20% in the K?
I'm sure it looks like it. And I mean, that sort of reinforces what you hear from the companies as well. I mean, you do see the Walmarts continuing to gather market share, which is not a good thing.
Because wealthy people are kind of downgrading, right?
Yes, some people in the sort of middle to high end are having to slum it at Walmart. But to the point on employment, a couple of things. Number one, this has been presaged by the consumer confidence and sentiment numbers for months and months, that the consumer has identified weakness in the labor market that has been universally poo-pooed by Wall Street, which basically says, they're just regurgitating what they hear on CNN or something like that about how awful things are. And in reality, they're really not that bad. But if you overlay consumer expectations about the labor market or current perceptions, it leads the unemployment rate. Like they have a much better handle on what's actually happening on the ground, not surprisingly, than the statisticians, be they in the government or on Wall Street. The second point I would make is that we've seen for a long time, I mean, at least 9 months, this situation where you've had the stock market levitating and the quits rate collapsing. And generally, when the quits rate, that's people who are just getting up and quitting their job without having another job lined up. When the quits rate is declining, it's generally associated with either a recession or a market that's crashing. As people start to feel really insecure about their financial future, they're like, okay, well, I'm not going to quit. I hate this job, and I'm not going to quit it because, the sky is falling out there. Right. Now you have this environment where the quits rate has absolutely imploded in the face of a stock market that's hitting the moon, and you've never seen anything like that before. So there's clearly, it's just to me another example of the underlying stress that middle to lower section of the consumer is suffering, that's being masked by this bubble in financial assets, that is the focus of Wall Street. And then, of course, Wall Street's focus on that is reinforced by looking at earnings that are skewed by the top 7 or 10 companies. So it's like this kind of echo chamber of good news, while the rest of the consumer just continues to get, more and more into the muck.
I mean, this really, begs the question around, how sustainable is all this? And of course, that's what we spend all our time debating and discussing. And this does make me think a lot about hey, I'm not sure it's a K-shaped economy anymore. It's more like a lowercase I-shaped economy, where there are just not enough of the people with the wealth to matter in the employment data, right? They become such a small enough percentage that, they're doing great, but because so many people are in the bottom half of that eye now, that's what's driving what's happening with the employment data. So like the quits rates, right? Even if everybody in the dot is keeping their job, doesn't matter anymore because there's just so many people in that bottom bar that are unhappy. Obviously this makes the system really vulnerable to a stock market correction.
Yeah.
Right? I'm not saying a crash. I'm just saying a cooling off, a correction, right? If that dot, or whether you like the K or the dot, if they start reining in their spending for any reason, but an obvious one just could be, my financial holdings just went down 12%. That could really have a much more outsized impact on the economy than in past cycles, correct?
To say nothing of a hit to real estate prices, which would be at least as devastating, if not even more so, I would think. But yeah, absolutely. I mean, I view the market as the tail wagging the economic dog here. And it's interesting because, you could get very conspiratorial about this stuff, but I don't think it's any secret to anybody around the globe that the US economy is only as good as ever levitating asset prices. Mm-hmm. So if you're Chairman Xi, for example, wouldn't it just be convenient to figure out a way to prick that bubble and create some kind of financial meltdown here in the US, at which point, you've pretty much thrown the US economy into a lurch that could reset the entire economic geopolitical playing field.
Well, let's tug on that for a second. And I'm no geopolitical analyst, but can he? Not could he implement that? But I mean, would that be cutting off his nose to spite his face? Like, okay, I trip up America, my economic adversary, but then they're not buying from me, and I'm trying to get my country out of this balance sheet recession. Wouldn't that just be kneecapping his own aspirations?
I mean, obviously, it wouldn't be without consequences for China, and he's already in pretty rough shape to begin with. But I'm just saying, we have a tremendous vulnerability. Our Achilles heel is the stock market.
Yeah.
Because we are so completely dependent on that. And I think, China might not directly target our stock market with some kind of cyber warfare or something like that. But they're essentially doing the same thing by unloading their Treasury holdings and forcing Treasury yields higher, or contributing to the inability to get yields down while the Fed is cutting rates. So that will at some point become a major issue for the stock market, given what we just talked about at the beginning, which is these increasing demands for capital. And the market is reliant on the stock market is reliant on continued access to credit, and as that cost, the cost of borrowing stays high or even moves higher, that's going to become a major issue for the stock market. I mean, I think it's going to be a real headwind. It's interesting. I wrote a piece called Paging Dr. Pavlov, in which I sort of posed the rhetorical question of how many times will investors have to hear the Fed rate cut bell ring without getting rewarded before they stop this conditioned response, salivating every time. It's like we've had 6 cuts that have accomplished nothing, and yet we're still salivating in anticipation of the 7th cut, as if that's going to be the one that finds the dog bowl full of all kinds of deliciousness. It's not going to happen. So I just wonder, the problem is we're trying to decondition 30 years of Fed Pavlovian training that we're going to be there and we're going to rescue you, and lower rates are the solution to all our problems.
I hate to say it, but I think, like training a wild animal, right? It's a combination of carrot and stick, or, treats in the rolled up newspaper. And I think you're only going to decondition the market, which is used to getting a treat every time the bell rings. It's not going to be the lack of a treat. It's going to be the rolled up newspaper. Like the pain is going to have to get painful enough for them to change. Yeah. And you mentioned earlier that we're at risk of a stock market correction and or a housing market correction. And, the housing analysts that I interview on this channel say, well, that's on. And this year will be the first year of home prices being down on average across the country in a good long while. And if you listen to the Melody Wrights of the world, it could really get bad from here. I mean, she is predicting, and I don't think too many others are predicting this dire of a forecast, but she is predicting that this housing correction will be worse than what we saw during the GFC.
Wow.
And I know that Melody doesn't come to that lightly. I mean, she's not a histrionic, fear monger. She's very data driven. But Melody, she worked at GMAC. Like she was in the heart of the mortgage industry as all the mortgages, were going belly up. So she really has a good understanding, both of just sort of how the plumbing of the whole housing market works and the financial side, but she knows firsthand how bad it was. She was helping GE, try to get out of all their underwater mortgages, and she was dealing with lots of buyers and hearing their personal stories about how their lives got ruined by this. So I don't think that that's a prediction she makes lightly. Now, will she be proven correct on it? Who knows? We'll find out. But point being is the housing market is further along towards a correction than the stock market is right now.
Well, I was going to make a point that admittedly is a subtle point that goes over most people's head, and that is that stock market is down. It's down in real terms.
Real terms, yeah.
So if you've got gold up, I haven't checked today, but it's got to be up at least 55% year to date.
It's up over 60 for the year. I just looked at the numbers. Gold's up over 60 for the year. Silver's up over 120%.
And the S&P's up 13 or something like that.
Yeah.
So you're down substantially in real terms, which again, it's a subtle point. I tried to make it on air recently and got literally laughed out of the room. So again,
you know how there's the collage of Peter Schiff was right, leading up to the 2008 crisis. I predict, Stephanie, someone's going to put together a compilation of Stephanie Pomboy was right at the end of all this.
Oh my God. Well, I mean, Lord knows I've been making the points long enough that there would be plenty of footage to make. But on the other hand, most people view that as, a reason to hiss and boo and hurl rotten tomatoes. But again, it's a subtle point that isn't viewed with any seriousness in conventional circles. Mm-hmm. But, when you're checking out the grocery aisle and you realize that what you used to buy for $50 costs you 120, you notice that, you are aware of the diminution of your real purchasing power. And it's the same with stocks right now.
What's interesting too about the stock market, to your point of it being our Achilles heel and being our point of vulnerability, it is for all the reasons that you mentioned. But increasingly, the needle just flips back and forth between greed and fear on the greed fear index. Like it almost doesn't have any intermediate settings anymore. Yeah. It is either everything is awesome or the world's ending. And we were just in the world is ending. And I went and looked and I was like, we're not even down at full percent point yet from the all-time high. Yeah. And so it's kind of like a shark, right? Or a shark has to swim or else it drowns. This market kind of has to rise or else it's just in freak out. And to me, that really shows that it is now sort of perched on a knife blade. And, as long as it can continue walking up that knife blade, I guess we'll be okay. But the further it goes up, just a little bit of, little breeze one side or the other that it's not expecting, could potentially upset everything.
Absolutely. I mean, one bad earnings report from a high profile company would do it. Or, I continue to look at the corporate credit space and private credit and all of that as a potential catalyst. But, whatever it is, the implications will be profound for the economy. And then again, for the currency, because our starting point is, 2 trillion plus budget deficits, and that number will double in the event of a serious
crisis.
Yeah, at least. And, where is that money going to come from?
So to that point, I thought I had sent it to myself, but I didn't. But I read another headline or an article this morning that talked about how, to your point about, the massive amounts of private lending now, that the bailouts, the next bailout is going to be both a public and a private bailout. And one of the reasons why I was so confident about private lending need to be bailed out, and I can't remember the exact stat, whether it was half of the debt or a third of the debt, but it's both big number in either way. But basically a third or a half of the debt held by the insurance industry is private credit now.
Yeah, I believe that. I mean, the pension fund exposure to alternative assets is like 40%, I think. So that doesn't surprise me with the insurance companies being that exposed to illiquid.
But the backstoppers, the guys who are supposed to be playing it safe, are loaded up on we just don't know what, right?
Yeah, but this is what happens in a world where you have a fixed return mandate and the Fed takes rates to zero and says, oh, your return mandate is 8%. Well, you can only get zero. So you're going to have to take ridiculous amounts of risk if you want to make that 8% return target. And not to mention, possibly, since you can't get 8% anywhere on the planet, maybe add a little leverage in there to juice the returns. So, I mean, the risks out there are enormous, and the market trades like everything is just perfect.
Okay, and I'm going to mention a couple of things here that are happening in real time as we're talking. Markets are down today. S&P's coming up on 1% or so. The NASDAQ is down over 1%. We have in the recent, couple of days, a week or so, we've seen some doubts, increasingly start to creep in around AI. So much so that Louis Gove, who I interviewed, the video released yesterday, he made the call. He said the AI bubble has burst. And he said it's now in the process of, it's all over, but for the crying at this point in time. And he was pointing to stocks like Oracle and Broadcom and a few others and saying, okay, that's the pop, and then the rest is going to cascade out of that. I said to him, wow, that's bold prediction. I'm not willing to go there yet because we're, at the time we're 1% away from the all-time high in the market. For me, it's got to be a little bit more visible than that. But we are seeing some challenges there, and Bitcoin, which has sort of been the most risk-on of risk-on assets, has been struggling, and it's now down again today to 86. But it's had a really tough time, reclaiming its six-digit valuation, being above 100,000 a coin. Yeah. We'll see what happens there. All I'm saying is we're seeing, some of the early indicators that we would expect to see if the bloom really starts coming off the AI rose here. Concurrently, 10-year bond is hanging out at 4.16 right now. So that's gone nowhere. To your point, we've had all these rate cuts. We've announced QE again, but it's not bringing that down. And then gold is up today again. It is about 43.60 right now. And silver, talking about gold futures and silver futures are now at an all-time high above 66. And Steph, I know you were bullish on gold and silver coming into this year, but I'm going to bet this is going to be even higher than you thought they would have gone this year.
Oh yeah, well, silver for sure. So that has been a moonshot, tremendous. I mean, I think at the beginning of the year, wasn't it 25? Somewhere around 25, I believe.
Yeah, like I said, it's up 120%. So yeah, it's about right.
Yeah. But this is a tremendous move. I do think that it's
just a little bit under 30.
Okay. Yeah, I mean, I think the case just gets stronger. And, I had talked about at the beginning of the year that we would have to go to QE. I've been singing from this hymnal for a while, and that was just for it. And now we're just barely opening the door on that. So I think obviously the future is bright for precious metals. The other point I would make, and it gets back to this whole conversation about capital demands and our bloated fiscal situation, and that is there's a fabulous chart that I saw the other day that overlaid the gold price with federal interest expense, and it's a perfect parallel. They just, you can't tell the lines apart, and unless you expect some relief on the interest expense front, it just looks like gold. It's just clear sailing. I also have done charts way back that overlaid the Fed balance sheet with gold actually leading changes in the Fed balance sheet by over a year.
Gold, like sniffing it out.
Yes. And so gold kind of sniffs out that the QE is coming and moves in advance. And it does look like that's right on cue right now. So, I mean, look for a substantial increase in the Fed's balance sheet, which they're now already beginning. Side note on that, since we were talking about housing as well, they're running off the MBS and taking those proceeds and recycling them into T-bills, which would seem to be starving the mortgage market and putting further upward pressure on mortgage rates rather than downward pressure, which in theory, this administration is what they really want. The reason why they want the Fed to cut rates is to provide relief, not just to the federal government, but to homeowners and unfreeze this housing market. So this stands at direct contravention of that goal. But I read something recently that said that Fannie and Freddie, while the Fed is unloading its MBS, Fannie and Freddie have been silently buying up a lot of MBS. So it may be just a wash in that score. It's going to be interesting to watch how that plays out, because they're also trying to privatize. There was talk about, privatizing Fannie and Freddie, and what happens if and when that actually goes through. I mean, these are all big questions that we don't know answers to, and we'll see play out in the new year. But I think the housing market and, Melody's thoughts on that are so crucial, is going to be a major moving part in the drama as we get into 2026 for sure.
Yeah, and that actually it's probably the next session I should do with Melody would be, the privatization, and would that be a good or a bad thing? Because I know Melody has a lot of issues with a lot of the lending that's been done by the government agencies, just giving out loans that have no business being given out, right? And I don't know, but I would assume that maybe privatizing it might lend over time a little bit more of a formal type of scrutiny to that.
Yeah.
So anyways, we'll see. Just on the PMs for a moment, and folks, if you have questions for Stephanie, start asking them in the live chat here, and I'll try to pull a few in. But you've been, a champion of the precious metals for a good long time. This year has been a real validating year for you, so congratulations. I know they have been a pretty large part of your personal portfolio. I think you've largely kind of been, precious metals and T-bills, I think, if I've taken decent notes. Have you made any changes to your personal portfolio, or at least to sort of your outlook on an appropriate allocation, given how far the precious metals have moved here? In other words, have they gotten to a point where you've said, hey, I'm actually making a change, or is this a trend you're still planning to ride?
Well, I mean, I guess I'm reckless because I'm just holding tight. And to the extent I've made any changes, it hasn't been to liquidate any of my gold position, but to shift some marginal cash. I didn't have much, but a little bit into energy names. So that's the only change I've made, has been to be a little bit more exposed to energy. And I'd love to do more, but that would require me to liquidate some of my gold holdings. And I guess I'm waiting for, I'm going to buy a lottery ticket later. So if I win the $1 billion lottery, then I'll
So, okay. Well, thank you for being transparent there. So I've been doing the same as you, which has been sort of shoveling new cash into energy names. And I think I've been fairly transparent about that. But again, folks, this is not personal financial advice. You shouldn't do what Stephanie's doing or I'm doing just because either one of us is doing it. You should talk to your advisor and do what makes sense for you. But I've been talking to a lot of people of late that, are looking at the energy sector and saying, look, it's been beaten down far enough for long enough that, and there are some signs that it's kind of beginning to come back to life here, that there could be a fairly substantial, if not even a potentially epic, recovery in that space. And talking to, again, Louis Gave yesterday, he echoed a sentiment that I've heard increasingly echoed on Wall Street, which is that, the traditional 60-40 model doesn't work so well in what may be a secular era of rising interest rates. And therefore, you may want to, hold a different allocation, maybe still 60 to stocks, but take a good chunk of your bond allocation and move that into other things. And in Louis' case, he's like, I've gotten out of bonds. I am in 60% stocks, mostly international. He's basically saying 2020. Personally, he's 25-15, but 20% energy and 20% precious metals. And he said, because the energy companies, a lot of them are, big companies that pay good dividends. He's like, energy companies are the new stocks. The new bonds. He's like, that's what he's looking at for the next decade plus. Curious to your reaction on that.
Yeah, no, I agree. I mean, I guess in general, I would be long commodities, as the third bucket rather than, just sticking with that 60-40. And I thought Goldman Sachs came out with some shift in their allocation as well.
They kept 20, and I'm trying to remember but I think the other 20 or part of it for sure was gold. I mean, we keep hearing more and more of these big Wall Street names now saying, you probably should hold some gold.
Yeah. Well, I look grossly irresponsible with my portfolio structure relative to what they're recommending. But no, I mean, I think commodities should be a large part, especially in this period now where we're heading to, we've already been through and we're going to accelerate our progress down the road of currency debasement, holding paper assets as we talk.
Sorry to interrupt it, so you can include this in your answer. How much of it is debasement for pro commodities versus global competition for resources and that type of stuff? Is it all debasement or is it a blend?
You mean in terms of why I want to be invested in that?
Why you're pro commodities?
Yeah. I mean, I think, I guess I would say it's at least 50% from debasement. And, but I would say it's probably more than that, because one of the reasons why global central banks are shifting from owning treasuries to stockpiling, gold, silver, rare minerals, building SPRs, et cetera, is that they see the currency debasement. So whether that's my objective sense as to what the risk is, or whether it's indirectly what's driving the fundamental demand for those resources, I think the debasement thing is a huge, is sort of the overwhelming force behind it. I mean, especially if you're talking about an environment where global economic activity is going to be generally softer. You really have to emphasize the debasement as the key driver.
Okay. And you think from a price perspective, debasement will overpower any softness in demand?
I would certainly think so. I mean, we've seen that so far, for sure. I mean, I sit here and I know the administration's taking a victory lap on oil prices being, below $60 a barrel, but they haven't collapsed by any stretch of the imagination. And we're supposed to look at 1% growth here in the fourth quarter. And, it doesn't seem like a backdrop where the commodity prices are necessarily reflecting the economic reality as much as they are the fiscal realities that we're facing.
So this user here says, if energy goes lower, I'll just buy more. Personally, I'm in that mindset right now, which is I I'm totally mentally prepared for oil prices to go, lower from here for a potentially decent while. And I'm looking at that as a good dollar cost average way to continue to add to my positions. I don't think it's a guarantee. So, we could find something that happens that, all of a sudden pops oil. So I'm not telling everybody to take lower prices in the future to the bank. But personally, given where I see this industry could be, it's increasingly smelling to me the way that the precious metal complex and the precious metals mining companies smelled to me several years ago. So that's the type of recovery I'm hoping to enjoy. Who knows when? 6 months from now, 3 years from now, I don't know exactly when it's going to happen. So on silver prices and oil prices, Steph. So an ounce of silver now buys more than a barrel of oil. And that's only happened, actually, I put up a chart that showed this has only happened once before. It actually has happened twice before, but the second time was like a millisecond blip, and that's when oil basically went negative.
Right, negative, right.
But it's barely ever happened, at least in the past 50 plus years. And so I guess my question for you on that, Steph, is a couple things could be going on here. They could be fairly priced, but oil could be really underpriced, right? We could expect that ratio to reequilibrate. Silver could be really overpriced, and it's had an amazing run, right? And I guess that even though the ratio is now out of whack to where it's been, maybe it's a new ratio and they both go higher from here. I don't know, but what do you have any strong thoughts one way or the other?
I don't really. I mean, I guess my sense would be that they're both going to move higher, and that the ratio of the two, maybe oil will start to pick back up relative to silver, but that they're both going to be moving higher directionally. So I don't have a particularly strong or insightful comment to make about that ratio. But I guess one snide comment would be that, with Ford getting out of EVs, the case for fossil fuels looks brighter and brighter every day. So,
right. Well, and that's one of the things that gives me confidence about the oil and gas trade, which is world demand for oil and gas just continues to go up.
Yeah.
And it always, it always has, even with, the advent of renewables, even with all the efficiency technologies that have been rolled out. We just have more and more of the rest of the world, forget about America and the developed world, but the rest of the world that is just coming online, right?
Yeah.
And then we're also finding things like, okay, a lot of the kind of green energy stuff that was sold to us isn't going to pay off on the type of timeline that we thought it was. And sure, nuclear energy will probably make a really big dent, at least on the electrical side, and I'm rooting for that. But I still think there's going to be overall increasing incremental demand for oil for as far as we know. And you've had, I've interviewed enough guys who really know the natural resources space to say, hey, we have underinvested in the CapEx in this sector for like the past 10, 15 years. And even if demand were to just flatline, which it's not going to, but even if it were just a flatline, we're going to have some shortage issues coming up here. So all sorts of reasons just to say, look, the death of fossil fuels has been likely wildly overexaggerated.
Right. My only concern, and it's just a near-term concern, is that if this questions around the AI, whether it's a bubble deflating or, all the promise of AI gets called into question, will people spank the energy sector as a consequence? I mean, I've been burned enough for being in the gold trenches for a long time and suffered through a terrible market for the gold miners for years and years and years, and seen a situation where, gold goes down $10 and the miners are down 4%, or, they just shred them, even though they were wildly underpriced relative to the bullion. And I just am mindful that kind of scenario could play out in the energy stocks as well, where even though they didn't really benefit from the AI trade, they'll get annihilated if the AI bubble bursts.
None of the halo and all the blame. Yeah,
exactly.
That very well could happen. I think that one of the things I think is somewhat different though is a lot of these companies, if you're dealing with the bigger ones, they're just very generous dividend pay. They have lots of cash flows. price. And that's different from a lot of the miners there. All right, Steph, thanks for going long here. Do you mind doing just a quick kind of lightning round with some of the user questions here?
Sure. I got a couple minutes.
Okay, we'll just do just a few. And people are making so many comments here that I can't now. Okay, here's a good one. What would make you sell precious metals?
What would make me sell a gun to the head?
Well, I guess what future developments would you say, okay, this trade is played out?
Actually, I'm being facetious.
Well, that's probably a true answer today.
Well, there will come a time when I will want to sell my precious metals and buy stocks that are wildly underpriced. You know, I am looking forward to a day, and it's ghoulish to say because it will entail a massive correction in the stock market to get there. But I'm very much looking forward to a day when I can invest in American companies at fair to cheap valuations, rather than sitting, you know, like some doomsayer in a corner, you know, cuddled up with my gold coins. You know, I'd much prefer to be invested in great American businesses that are growing. And I do imagine that day will come, but not until after we have a gut-wrenching reset that probably entails a reset of the currency regime as well.
Oh, well, I'm right there with you. I can't wait for the day where instead of being tarred as a perma bear, people are calling us perma bulls.
Right? I can't wait either. Exactly.
Yeah. Kindly ask Stephanie about deflation, as Lacey Hunt predicts, or hyperinflation. And I'm going to guess that you might say one than the other, more or less.
Yeah, precisely. I mean, I am fully on board with Lacey's arguments for deflation. I think he's got it nailed. And we actually joked when I saw him at a conference a little while ago about how few people understand the law of diminishing marginal returns, you know, and if they did, they would understand why deflation is the path of least resistance for the U.S. economy, just because the more debt we add, the less benefit we get from each marginal, you know, dollar. So we just need more and more debt, and that's an incredibly deflationary scenario. And then layer on the demographics on top, and you've got a real recipe for deflation. But the solution to the deflation will be to run those printing presses 24/7, which I think would create the threat of hyperinflation, but I don't think we'll get there because I think we'll be forced to change the monetary regime, the currency regime, before we get to that point.
Okay, and this is something that maybe I'll earmark for you and I to talk at greater depth in a future one of these. But talking with Melody Wright the last time I interviewed her, you know, for years and years when I've interviewed these housing people, I have raised the question of, you know, will there be kind of a deflationary multi-decadal wave as the boomer generation really starts to die off? Just being as frank about it as I can, where they're just going to the nursing home or the cemetery, and in most cases, you know, that house is going to get sold, right? And you're going to have this relentless wave of that happening every day to 10,000 boomers, right? And you know, and they've largely said, yeah, that's probably going to happen. But it was an academic discussion up until my last conversation with Melody, where she said, it started. I can already see it in the data. It is beginning to start now. And obviously that'll depress housing, and that'll have lots of economic implications. But also too, it'll have implications for boomer portfolios. So in some ways, you can make the argument that, I don't know, maybe it'll be stimulative. All these people are inheriting cash, and then they'll start spending it more.
I was going to say, that's the counterpoint, is that the heirs to that estate will suddenly have all that money. And so, you know, there's supposed to be this great wealth transfer that's going to be taking place. So.
Right. But here's a question to that, which is, well, who's going to spend at a higher rate? The heirs who get the money, or the boomer who is in their last couple of years, which is where you tend to spend the vast majority of your money on healthcare and stuff.
That's what I was going to say. Yeah, to healthcare. And Lord knows that's inflating rapidly. So that's a lot of money that it's sucking out of.
So this is a conversation I think that requires more than just 30 seconds to react to. But I do wonder if that big bolus of money that is going to get passed along will be as large as is expected, because I think it might get attrited in the boomers' later years, might get attrited by a big market correction too. That's obviously a big TBD. Might get attrited by falling housing price. There's a whole bunch of reasons why that thing could get really nibbled away before it actually gets passed along.
Yep, and sadly, we're both in a position to comment on that from personal experience. So anyway, but yeah.
Sorry, last question here, which is, what are the chances of a market-wide sell-off that could cause a liquidation event where even gold and silver get sold off too? I know you get this question.
100%, right?
Yeah. Your expectation, though, is that they would bounce back the fastest, right?
I mean, I think it would be foolish to presume that gold and silver would be spared, especially given the enormous amount of leverage that's underlying all of these exposures. I mean, we have to imagine that hedge funds, albeit late to the party, have participated in the precious metal move, and that when they're forced to unwind exposures across the board at 10-to-1 leverage or whatever numbers they've employed, we'll see a pretty meaningful hit. But again, I do think that will be very temporary.
And I assume you expect sort of like what we saw during the GFC, which is everything gets sold in the downdraft, but then the precious metals recover quickly. And if you were nimble back then, you could have actually traded some of that for really low price stocks, right?
Yeah, I mean, I'm not clever enough to do that, which is why, my father had this one axiom. He used to always tell me, never lose position in a bull market. And so I would resist selling in anticipation of that and sooner buy puts or somehow hedge some of my exposure rather than actually liquidating and trying to get clever and figure out when the time to buy is. But I'm not a trader, as everyone listening to this can tell very clearly.
Right. It's macro mavens, not TA mavens, right?
Right.
Yeah. All right. Well, look, in wrapping up here again, Steph, a couple quick things. One, because we talked about silver, I just want to make sure that those of you that haven't already heard Andy Schectman on this program, when silver cracked above $60 an ounce, I asked him if there was anything we could do in celebration of that, and he said, "Yeah, I've actually got a great deal on junk silver. I'd be happy to offer the Thoughtful Money audience exclusively the ability to buy junk silver from me at $1 below spot while supplies last." So supplies are still lasting, as the last I checked. And so if you want to take advantage of that, just go to thoughtfulmoney.com/buy gold, fill out the short form there, and then Andy and his team will help you buy as much junk silver as you might want to buy right now. All right, Steph. And then for you, again, remind people where they can go just to follow you and your work, but also if they want to sign up for the super terrific happy day, where they should go.
Yeah, I will go ahead and post that link again on Twitter, and my handle there is @spomboy. So you can look for that, or you could go to macromavens.com and just email through the contact page for information, and we'll send you the link to where to sign up with the agenda and all of that. So, but again, it's right after the President's Day weekend. I think that's February 17th and 18th in St. Pete. So it'll be beautiful. And we'll have fabulous folks there, including Mr. Adam Taggart.
Thank you. Well, I'm very appreciative, again, to be invited, but also of the timing. The last time I was in February was for Rick Rule's great symposium, but he does it in the middle of July, where it's just,
disgusting.
Freaking oven there. Yeah, exactly. Of course, he does it because he says it's the cheapest weekend at the hotel because nobody wants to be there because it's so hot.
He's a true value investor.
Yeah, exactly. So anyways, I very much appreciate you doing it at a time of year where those of us in winter climes would love to go. All right, Steph, look, thank you so much for being on here. Folks, please do me a favor. Please show your appreciation for Steph there in the live chat or in the comment section below if you're watching the replay. Please let her know you appreciate these monthly times that she comes on and gives us so much of her time by hitting the like button. And then if you've got time, go into macromavens.com and checking her out there. But Steph, can't thank you enough.
Thank you so much. And Merry Christmas.
Thank you. Merry Christmas to you and to Wilhelmina. You can give her that nutcracker now.
Oh, yeah.
All right, Steph, thanks so much. And everybody else, thanks so much for watching.
The purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation. They lowered their U.S. GDP growth forecast for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. This is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what did they get? They got Hitler.
Germany experienced 3 stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned. And the third, from late 1921 to 1923, concerning parallels can be seen in the US today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. I mean, you mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were 3 phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, and a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is what, 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. I mean, they are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, I mean, everybody, including the large institutions, stand back and they don't buy Treasury bonds. I mean, certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. Because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.
Now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1900 consolidation. That was a six-fold increase. If you assume we go up six-fold from 2000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. There's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. Once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months.
Gold can rise dramatically, potentially reaching $12,000 if the next leg matches past gains, with even higher levels possible in the event of a US dollar or debt crisis. They attribute the rally to America's poor fiscal and monetary policies. For silver, once it breaks above $50 and holds that as support, they expect a rapid surge toward $100. Peter Schiff, the speaker, is a prominent financial analyst, economist, and CEO of Euro-Pacific Capital. He contends that the Fed's rate cuts in the face of growing inflation are contributing to the increase in gold prices. Mining stocks rose 30 to 40%, indicating that investors are now embracing gold's power. In an effort to lessen their dependency on the US dollar, which would make it more difficult for the US to pay for imports and debt, central banks are purchasing gold. Gold is a useful substitute for fiat money since it can be easily utilized for payments through tokenization or digital systems, thanks to modern technology. Gold is the real money of the free market since it maintains and even increases worth over time, unlike currencies, which depreciate. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad. And we got a long way to go. But, the whole time that gold was going sideways for 3 or 4 months, gold stocks were quietly going up. Gold stocks went up 30, 40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices, but at least they're pricing out a crash now. People accept, okay, gold's going to be around this level, so we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the number one performing sector in the market this year, and they're hardly ever discussed. No one talks about them. Well, I think that is going to happen. I think it's pretty clear. If you look at the main buyers of gold the past couple of years, it's been foreign central banks. Why are they doing that? I think they're preparing to replace their dollars with gold. I think gold is going to become the primary reserve asset for central banks. And that's going to be a game changer for the United States because the world is not going to need our dollars anymore. Well, if they don't need our dollars, then how are we going to buy all the stuff that we need because we don't produce it? And how are we going to finance our debt? Because we've been relying on foreigners to finance that debt because they have the savings that we lack. So it's a big problem for the U.S. But I think from a monetary perspective, you're going to see, I think, people utilizing gold using the technology that exists today, whether it's on-chain with, tokenized versions of gold, or whether it's just through proprietary closed systems where the custodian has the gold and just uses technology to allocate ownership digitally so that people can transact business, receive and make payments, send money and receive money using gold, right? Just like using PayPal or Venmo or any other Zelle or any of these things, you can just use gold. You don't have to transfer your gold. If I wanted to buy something from you and you wanted me to pay you, a gram of gold for it, right? Whatever that is, 30, 40 bucks, whatever, right? I don't have to send you a little bit of gold in an envelope and mail it to you. If the gold is held in a custodian and I have it tokenized in my wallet, I can just email or text you the gram. And now the ownership of the gold goes from me to you. So now you own the gold, not me anymore. You've got it. It's in a vault. Now, if you want the gold, you can have them ship it to you. But why do that? Just hold on to the ownership receipt, because now if you want to buy something, you can pay with gold, because the guy that wants to sell you that, he wants gold too. Why would people prefer gold to dollars? Because gold holds its value. Why would I want dollars when I can have gold? It's like, why use the post office when I can send something by FedEx, right? The free market has provided me with a better alternative than the government, right? Why do people use Uber and Lyft? Because taxis are too expensive. Why are taxis expensive? Because the government provides the licenses and regulates them, and so they're expensive. The free market alternative is, well, I'll just call an Uber, right? So the equivalent of an Uber in the monetary system is gold, right? Gold is the free market's money. Fiat is government money, and it's lousy because it loses its value. The longer you hold it, the less it's worth. The opposite is true of gold. The longer you hold your gold, the more it's worth. So given a choice, which would you hold?
According to Peter Schiff, the $50 mark, which was last attained in 1980 and 2011, is a significant barrier for silver. He anticipates a sharp increase to $100 once it breaks above, because shorts will have to cover. This was largely driven by global industrial demand, which, according to the Silver Institute and Metals Focus data, rose by 4% to another record of 680.5 million ounces in 2024. For the time being, he would rather Wall Street remain closed so that his clients can purchase gold and silver equities at a discount. Despite extensive marketing, Bitcoin has underperformed gold for years. He suggests purchasing gold mining equities in addition to actual silver, since he believes they are still cheap. He prioritizes selling gold at modest markups over expensive items at his business, Shift Gold. He cautions that it is dangerous to wait for dips because prices are rising and a reversal will probably occur from much higher levels by then. Let's get deep into the interview.
Very realistic. I mean, especially if you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist. I actually like the fact that this bull market isn't on anybody's radar, because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold. So maybe he's figuring out that Bitcoin is the wrong way to go. But, it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin. All the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the strategic Bitcoin reserve and the Bitcoin czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be. So we got a long way to go in the mining stocks. In fact, in April of this year, I kind of aggravated some of the guys at Shift Gold because I put out this report that said the best way to buy gold, and it was to buy the gold mining stocks. And I was telling my clients for the first time not to buy gold. And gold was around 3,200, 3,300. And I said, look, I'm a gold bull. I love gold, but these gold stocks are so cheap that it doesn't make any sense to buy gold above ground. Just buy it while it's still in the ground because it's so cheap. And while gold went sideways for all those months, the gold stocks were soaring. And they're not as cheap as they were, obviously, but they're still very cheap. And I still think people should be buying gold stocks and gold now, and physical silver and these silver mining stocks. So, Shift Gold is my gold company. What you want to don't do, there's so many, unfortunately, shysters in the gold industry. And they rip off their customers by pushing them into these numismatics or collectible coins, fake numismatics, proof sets, odd weighted, coins you've never heard of. And they do that because the markups are 30, 40, 50% or more. And so you need the price of gold to go up 50% just to break even. So why buy gold at 3,600 if, you need 5,000 just to get out even? So at Shift Gold, we're marking up gold like 1%. So if you bought gold yesterday, you can sell it back today and make a profit, right? So you don't want to get ripped off. So going to Shift Gold, you're going to get the best prices. You're going to get just bullion. We're not going to try to push you into something that makes us money. We're going to sell you what you need to make yourself money. My goal is to make a little money on volume, not on ripping people off. But that's also interesting. Like Shift Gold's phones are not ringing off the hook. I mean, it's slow, and that's the same throughout the industry. And what the Shift Gold guys have been telling me, our reps, is that customers have been reluctant to buy because they're worried about buying the high. And I've been telling our customers all year, you got to buy the high because that's all that you're going to have the opportunity to do. The problem is the longer you wait, the higher the high is going to be. So you just might as well buy now. I mean, because you're not going to get a big enough pullback. You'll get some pullbacks, but why wait? It's not going to be enough to make a big difference. And the risk is that by the time you get a pullback, it's pulling back from a price that's much higher than if you just bought it right now. I don't see any panic to buy. Gold's not moving up $100, $200 a day. I mean, that's going to happen. I mean, it moves up $10, $20. I mean, today, $50 is a big move because we got data. But, I haven't seen anything crazy. The gold stocks go up 2%, 3%, maybe 4% in a day. Then they pull back. They're not up 10% in a day. They will be eventually, but we're not there yet. So, people should get on board on the mining, on the metal at Shift Gold. And gold stocks, my gold fund, I'm very partial to my gold fund that's managed by Adrian Day. But I think that the hidden value in my gold fund is our portfolio of very small junior miners that would be almost impossible to buy today, given the liquidity. But these stocks haven't moved the way the big ones have because the money that has been flowing in has been buying the Newmonts and the Barracks and the Agnico Eagles and the Franco-Nevadas and Kinross and I Am Gold. I mean, they're not buying the little ones.
Peter Schiff's outlook underscores that gold and silver remain deeply undervalued in the current environment. With central banks diversifying away from the dollar, inflation eroding purchasing power, and precious metals poised for technical breakouts, he believes now is the time to accumulate gold, silver, and mining stocks before Wall Street and the broader public catch on. Do you think silver will finally break its decades-old $50 ceiling in this cycle? Will gold's rise to potential new highs force central banks to accelerate their shift away from the US dollar? Share your thoughts on Peter Schiff's analysis in the comments section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now. But the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work. And if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls. All credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold-to-silver ratio potentially falling from 90-95 to 1 back toward its historic 15 to 1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the endgame investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland Allison Act, 1878, and Sherman Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15-to-1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've been talking about the pyramid, right? And gold is at the bottom. But underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading in the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, it was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. what happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. Right? And so they had a lot of gold. So what's the best way if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But like everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor, for the favor of the rich. We have to go through a reckoning. That's natural law. Like just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like the bell's ringing. Okay, well, dollar has collapsed. It's going to be at a 15-to-1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two, 3. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve or however you think the banking system functions. What does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like if the South had won the Civil War, you'd have the Confederate States and the Northern United States. So it might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting. They're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation or something. Or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. prices are actually, they've been going down since 1960s. I mean, if you look at everything priced in money,
And gold.
money, I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, so then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up. But you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. That's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. So it's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think, but you can't go completely into their world. But you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to. It's a very difficult position where we are, because we have to put a leg in the illusion and we have to keep a leg out of it and keep our minds together, which is it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me. That only I think in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver in this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.